Hello, welcome to another talk on money, business, and investing. My name is Jose. I'm the chairman of our brand and company here at Master Investor. Ensure to subscribe, turn on the notifications so that we know when we go live or upload a valuable talk that can literally change our finances as long as we're applying the information that we're learning. Today's topic is going to be what type of investors are we? Discover the three types of investors because not all investors are made equal and find out which one is the best type of investors to be. Take a look at our website because we have digital courses, ebooks that we can start studying and implementing the strategies within those digital courses into our business and investment that we are embarking on. Okay, is going to help us with understanding how to automate our sales, how to get unlimited leads, how to raise capital, how to have the integrities of a successful business well established in our businesses so that we can turn them into real brands. It's important that we understand how to do that. It takes financial education. Today, we're going to learn which type of investor is the best one to be. And one thing I want to cover is that we should not be an average investor, right? That's the one tip of today's talk is not to be average, to be extraordinary, to understand how to master money like the ultra wealthy, operating with the wealthy context, which is more important than content. Today's summary: are we making money? Passive income, using our current approach to investing to determine what kind of investor we are. Consider this question. Although many individuals identify as investors, the kind or type of investor has a significant impact on long-term outcomes. Financial literacy is the key to true financial success. Keep in mind that the most dangerous strategy is average investing. Begin by identifying our investor profile in order to develop or acquire a successful system or systems. Because as we learn here in our community of Master Investor, a true business is a system of systems. At the end of today's article, we will cover our bonus question. What are the pros and cons of real estate investing? Real estate is one of the 5 asset classes that exist today. We have number 1, real estate; number 2, business; number 3, crypto; number 4, paper assets; number 5, commodities. Mastering investing in real estate investing is essential to grow our wealth. This asset class of real estate allows us to use debt, leverage, control, taxes, appreciation, depreciation, and other strategies to increase passive income. It is easy to call ourselves investors. People across the world have claimed that they invest and are investors, but that does not actually mean much. Investing is a complex subject, and it means different things to different types of people. That is why understanding this knowledge is essential for our wealth building journey. We must ensure that we are investing like the ultra wealthy and not like the average people tend to invest. Typically, we have to go through a series of inquiries to really understand the type of investor we are. The diagram below show how around the 3% of the population, the NSI investors who have financial education, control 90% of the world's wealth. It shows that our priority is investing and becoming wealthy by acquiring assets that produce cash flow. The way we operate and how we manage our cash flow is different as to the average investor, or around 98% of the population. As we can see on the diagram, it shows that our financial statement in simple manner, we can see the income statement and the balance sheet. And we, inside the income statement, we have the income column, expenses, and then on the balance sheet, we have assets and liabilities column. And as an inside investor, as a true investor, as a master investor, as someone that understands how to create wealth, like the ultra wealthy, by acquiring assets, by using debt, by utilizing also taxes to create wealth, because we use taxes as an advantage because we understand that the tax code is a package of incentives for the business owner and inside investor. Those who play with the rules of the wealthy, the rules, the new rules of money, actually, because they're there for everybody, regardless of our background, of where we come from. That does not matter. We can create wealth successfully, and today we can do it fast because we have technology and artificial intelligence. But the main focus is to, instead of focusing on income coming from a job or a salary, we focus to on building passive income, and sometimes we'll have capital gains income through sound investing. And so our focus is on the assets column on our balance sheet. Majority of people, 98% of people, focus on high income from a job. They don't focus on building assets. They spend majority of their time working at a job, selling their time to build earn income, and it's taxed at the highest bracket. We understand that there are three types of income. We have earned income, which comes from a job, or when a person has their own firm, like they have to be there to see their clients. That's still a job. They're still selling time for money. They have to show up to see their clients. So they lack systems, and so they earn what is called to be ordinary income or earned income, which is taxed at the highest bracket. And then we have capital gains income, and then we have passive income. Those two comes from investing, the last two. And here at Master Investor, we encourage everyone to focus on passive income as a priority in our investing strategies, because that is the type of income that is taxed at the lowest bracket, lower than capital gains income. And it also gives us total freedom. Is the type of income that gives us true wealth, because it comes in constantly into our pockets, because we are controlling real assets that are producing passive income, or also known as positive cash flow. And we know that the most important words in the business language are cash flow, and the second most important words are due diligence. When we combine them together, we can ensure that our return on investment is secure, because we're basing it and we're measuring it with facts, which is important. A lot of people invest with opinions, and we're going to learn more about that in just a moment. Three types of investors. This is because there are investors, and then there are people who dabble in investing. Have we ever wondered why some investors make more money with a lot less risk than others? Those individuals are a different sort of investors with a distinct outlook. The investors have been classified into three groups, or three types of investors. Here are Master Investor. Investor type C. Type C investors are financially uneducated and look for people to tell them what to invest in. They invest with opinions instead of facts. They are not particularly interested in making investments in their education in order to improve their investment skills. Since they are ignorant about finance, they must depend on the counsel of other so-called professionals. The likelihood of a type C investor achieving financial independence is about the same as winning the lottery. And a person who usually wins this lottery, he or she end up losing the money because they don't have financial education with them. And what money does to all of us is it really magnifies who we are. So a person's mindset shows even more when he or she possesses capital. And so that's why we can see throughout history that people that win the lottery, usually end up going back to the same place where they started without money. And we also understand that it does not take money to make money, because that was a perfect example with the person that wins the lottery. That person had money but couldn't make that money make money. They ended up wasting it on only liabilities. They didn't understand how to multiply money because they lack financial education. So we can say that it does not take money to make money. What it really takes is financial education, financial knowledge, which is the new money in this age, which is the information age. 1980, 1989, that's when we enter the information age from the industrial age. And it requires us to see the world with our minds rather than with our eyes, because everything is becoming invisible. Everything is digital, and also everything is moving fast. So that means that we have to learn how to adapt and how to position ourselves and how to catch new trends, how to capitalize all the spirit and the entrepreneurial eyes. And that requires us, we want to be successful in all the asset classes, and we want to make sure that we invest in each asset class for the understanding on each asset class that requires us to understand how to create passive income. We need financial education. They're all different. All the asset classes are different. Although it's the same wealthy context behind it, they still different procedures in the different asset classes. So we have 5 asset classes. The newest asset class is crypto, which crypto today is more than an asset class. It's now became a currency. Today, crypto is a currency like the US dollar. So we have the 3 crypto, like what it is money. We can pay each other. We can invest into crypto and also use it to pay other businesses. And we can, as business owners, we can also accept payments in crypto, which is a great strategy to improve our bottom line, our cash flow, because as crypto can go up and down, usually if we're investing in the right cryptocurrencies, such as Bitcoin, Ethereum, etc., we have an ebook on that, how to invest in crypto to build wealth. Check it out on our website. We have a digital course. When we getting any of our digital courses, we will be locked in for life, meaning that any asset that we add into that digital course, we will have access at no additional cost, regardless of that digital course going up, because it will going up on price due to the fact that we're adding more assets to emphasize more on the topic of each ebook. So we have how to build cash flow with the internet, turn passive income on. That's a great ebook to read and to apply into our business and investment strategy. It's 49 chapters, is filled with financial education and actionable steps to understand how to control systems, because ultimately a business is a system of systems, and every investment is a business. The more we know about business, the more we understand investing. It's not investing that is risky, it's the investor or the person behind the investment in the business that makes it risky. So we need to take a look at our team. Who are we talking to? Who are we networking with? What type of contacts are we getting into our email autoresponder, where we collect all the data of our emails? We need to have a database of people, that a community that we have to serve with valuable content and whatever product is that we selling and providing to the world, because we want to build businesses that are product based. That way we can separate ourselves from the business and we can build a different asset. Remember, we have to build true businesses, real assets. A lot of people call assets what really are liabilities. An asset is a system or systems that put money into our pocket whenever we're not working, because it's delivering a product that is in high demand. And we have successfully used systems and smart marketing to do so, to put that product in front of those customers that want that product already. And then also we choose a niche that is scalable. We want to have a scalability in our businesses and investments. So, three types of investors. We were talking about investor C. And we said that the likelihood of a type C investor achieving financial independence is about the same as winning the lottery. So don't be average, don't be an investor type C. Improve our financial IQ, invest in financial education, go to online seminars, invest in our financial education, invest in real mentors that are doing what we want to do, and we can see by the work that they produce, and success leave clues. So listen to the message, listen to what they're saying, and make sure that we're consuming the right data, because in today's world, that is the information age. And I like to call it the entrepreneur age, because it really is. We have to bring out the entrepreneur spirit out of us, and we all have it. Some people have it dormant, and it's okay. We're going to wake them up if they want to. A lot of people may want to stay in their job career, and that's okay. We still encourage those people to learn how to invest, because at some point they may want to retire, and they want to have that income, at least supplement the income that they used to make as an employee with their investments that they now control, and hopefully even bring some more, because when we have a sound investment that is creating some sort of cash flow to our pocket, and when using debt, then usually that investment is scalable, and we can grow the bottom line. The more attention we put into it, the more systems, the more marketing strategies we add into our plan, then we can acquire additional customers and assets as well, to improve the bottom line of that business. Because each business, just like each person, has a financial statement, and we need to learn how to improve the financial statements, how to read them, so that we can know exactly what is an asset, what is a liability, what's a good investment, and what is a toxic investment. Two types of debt that exist: good debt and bad debt. So we're not scared to debt, right? To have debt, to control debt. We want to be in debt as much as possible. The world is run on debt. The money is created with debt. That's why debt, generally speaking, is tax free. And when we build passive income is also tax free when we have a tax strategy plan ahead with our tax attorney and our CPA. And it required us to implement legalities and the boring things, right? Some people don't like to do these things at the beginning of their investment career, because they think it's boring. And it's like, okay, we have to learn about this. Yes, we do, because this is the foundation of having a solid business that grows into a real brand, which now is not longer a commodity. And how do we do that? We add intrinsic value and business integrity. And that is when we have intrinsic value, is when we are protecting what we are creating, or what the company is creating for the world, the product. And if we need to do a patent, then we apply for that and we have it in place. We do our logo, we register, we trademark, we do intellectual property. All the legalities are in place. We follow the 8 integrities inside of the cash flow triangle. We can find the cash flow triangle, and we will talk about it in a little bit, but we will find the cash flow triangle inside of our ebook, How to Build Cash Flow with the Internet, and just about each ebook we have, because everything relates to everything in our content here at Master Investor. Our mission is to elevate the financial well-being of humanity. I appreciate the time and business that you are providing to our community and our company here at Master Investor. Investor type B, investors in type B want solutions. They frequently ask questions such as, Number one, what should I put my money into, in your opinion? Two, do you believe I should invest in real estate? Three, which equities will be a good fit for me? Four, my broker advised me to diversify when I spoke with him. What are your thoughts? Five, I received a few shares of stock from my parents. Should I sell them? It is recommended that Type B investors meet with a number of tax counselors, lawyers, stockbrokers, and real estate brokers. They should seek out counselors who live by their words and avoid anybody who offers investment advice and makes a fortune only through fees and commissions. Type B investors should look for investment advisors who make money investing in the same investments they are selling. Due to their busy schedules and lack of time to seek out investment opportunities, several high income workers and self employed people may fall under the Type B investor category. Investor Type A. Type A investors, we seek out financial problems to solve them. Specifically, we search for issues that arise from individuals who are experiencing financial difficulties. Investors with strong problem solving skills anticipate earning between 30% and an infinite return on investment, or also known as IROI. Money for nothing, free money from thin air. Legally, we have a solid financial base and the abilities necessary to be successful as a business owner and inside investor operating on the right side of the cash flow circle with the wealthy context. We can build, acquire assets. We can start something from an idea and turn it into a real business that profits. And today we can use systems. We have white labeling. We don't even have to have the product physically, even if it's a physical product or a digital product. We don't have to have it in our possession. If it's a digital product, it's digital. If it's a physical product, we don't have to have it in our possession. We can build our entire company from our computer or smart device, and it can grow tremendously across the world without ever touching the product, because we are understanding the power of true brands and how to acquire new customers on autopilot using systems and smart marketing and utilizing all the platforms that we have available for social media and any type of content creation so that we can reach more people. We want to be in niches that can grow, that we can acquire new customers, because we're solving a problem that basically everybody has. And we need to figure out a problem that people have today, and we can solve that. Okay, not just a small group of people, but we want to have as many people. Hopefully, it's everybody, right? So we have to be creative when it comes to building wealth, because as a Type A investor, we must understand how to raise capital. We understand how to read financial statements. We actively take control over our investment strategy. We don't give our money away to anybody. We do invest with other people, other investors Type A, and we become partners so that we can leverage even more capital and acquire bigger assets with support. Usually Type A investors, we think alike and we understand what's important, which is cash flow. What is our cash flow? What is our positive cash flow that we're going to be collecting every month, every day after all expenses are paid? How much debt are we using? Let's use 100% debt, minimize taxes all the way to zero legally. Let's roll the profits into a new cash flow and asset, and we build partnerships that are based on win-win agreements. So we reach infinite return on investment, which is when we are controlling an asset that produces positive cash flow, and we have none of our capital into our investment. In other words, we have either recouped the initial capital invested back, or we're using 100% financing. We're using debt. And if that debt is creating passive income, because let's say the debt service is being paid every month by the cash flow of the business, and whatever is left is our positive cash flow, that positive cash flow is infinite return on investment, because we have none of our capital invested into the deal. We're using OPM, other people's money. We're using the bank's money. We got a loan, and now we're utilizing that to acquire a real asset, and that asset is producing positive cash flow, and that cash flow is being used to pay for the debt service, the expenses of the entire asset, the entire operation, and whatever is left is our positive cash flow. That's the bottom line. That's what we're looking for right there. And we want to have systems in place, and we want to learn how to delegate to the right people, the right professionals, so that we can build a team around each asset, so that we can depart from that asset completely. So our mindset is, and our strategy is to work on our businesses, not in our businesses. Meaning that we're going to be adding systems and delegating and doing less and making more. A type A investor is lazy when it comes to building wealth, in the sense that we are using our minds rather than our physical body to do a lot of work. We put a plan in action, but we need to think and grow wealthy. It's important. Okay? We have a solid financial base and the abilities necessary to be an inside investor, okay? And having the wealthy context requires us to update our data in regards to money, because we understand that money evolves, and we need to go back to history, see the changes in law, so that we can make sure that we are building our assets with the new rules of money. As money evolves, new rules of money will emerge. We created our ebook, The 10-Year Rules of Money. Go check out that ebook on our website. We apply those abilities to address challenges brought on by individuals who lack them. We begin investing with zero of our capital by using good debt from credit cards and other loans. For instance, we concentrated on little flats and houses that were in foreclosure due to issues brought about by investors who failed to manage their cash flow and ran out of funds. We rent them for tourists and short rentals, bringing enough cash flow at the end of month to cover all the expenses, including the debt service cost, and it leaves us with positive cash flow, or also known as passive income. And that is how we know we have an asset, because it makes us passive income and wealthier today, not in 10 years from now, not in 6 months from now. We need to measure our return on investment, and the speed in which we get that excess of cash flow is important. We want to touch that money. We want to be able to grab that capital, whether it's digitally put into our account, so that we can invest it into other assets in different asset classes. We want to multiply money, because the job number one of an inside investor is to multiply money through sound investing, whether it's through debt that we're using that strategy, meaning that we're using capital from pure debt, and we're using that as a form to leverage ourselves to wealth tax-free, because the more debt that we control, the better it is. So we don't want to be afraid of debt. We want to understand how to manage debt, how to control debt, and how to get into good debt as much as possible, so that we can get in as much bad debt as we want to, because bad debt goes with liabilities, and some liabilities are luxury items that we want, vacations, hobbies, etc. And there's nothing wrong with having liabilities and bad debt, as long as we have good debt and assets that are paying for the bad debt and liabilities cost. And that way is for free. Everything is free, because we are building the assets column. We're focusing on investing as a priority on our expenses column, we have investing as number one, meaning that our expenses, number one expense, we use our capital to invest so that we can become wealthy and we can increase our buying power. We increase our bottom line, our positive cash flow that is tax free. So we want to be building tax free wealth, which requires high level of financial education and a commitment to be flexible and adaptable with new changes that are coming at the speed of light because of technology and artificial intelligence. We need to understand how to use systems and be okay with doing less and making more, using our minds more than our physical bodies to get wealthy. The person that works all day for earned income has no time to become wealthy because he or she is spending the entire time working at a job that requires them to be there, and therefore they lack the time to build true wealth. And usually those people end up giving their money away and they have a bad taste on investing because they lose money. They don't really win money. They end up wasting all their money because they lack control over their investments. And the people that invest in their money usually are people that lack financial education. They don't make money through investing. They make money through commissions and fees. So when we have passive income coming in from an asset, that's how we know we are controlling a real asset because it's making us wealthier. When an asset makes us money on autopilot because we have systems in place doing the selling and telling for us, then we are sure that we have a real asset. There are people who only invest in fake assets, something that appears to be a good investment, but it is nothing more than a liability. The financial uneducated calls a liability an asset by not understanding that such liability is making them poorer, not wealthier. We continue to search for problems, but now the numbers are greater. We may begin to aim for bigger deals, such as acquiring 30 million mine investment. The approach is the same, even though the issue and figures are larger. The typical or average investor, he or she paid $500,000 for a home and now is worth $750,000. The average investor most valuable asset is a house in their mind, which is a liability because of the way they are operating the house. They are living in the house and they have to pay for that mortgage every single month, and they pay it via a job that they control, that they have, which they show up every single day, and they spend more time at the job than they do at the house. And who's paying for that debt? That's the question. If they're paying for the debt, then that is a liability. It's not an asset. Now, if he were to put the house, he or she could put the house to rent on Airbnb, for example, then that house become now an asset because it is putting money into the pocket of the landlord and is paying the debt service on its own. However, we know that such house is a liability unless it is rented out for passive income. Today, the retirement account is worth 1 million. He or she will say, an average investor. It would be worth 3 million by the time he or she retires. All this language and approach to investing is coming from someone who has the poor context and operates with it. Another example, the average investor will say real estate has averaged over 4% annually for the previous 20 years, while the stock market has averaged an 8% annual increase since 1974. Have we ever heard someone say something like this? These claims demonstrate that investors are counting their chickens before they are hatched. This investor does not know how to invest with a wealthy context. He or she lacks the 3 E's of a master investor. The following are the 3 E's of a master investor. Number 1, financial education. Number 2, financial experience. Number three, excess of cash flow. Facts are not the basis of any of the assertions made above. Rather, they are based on the word of others' opinions in the hope that the future would turn out as they wanted to. In other words, a person that lacks financial education bases their investments returns or the return on investment with opinions. They invest with opinions. They don't look at facts. They don't know how to read financial statements. They just hear that this investment vehicle is hot. This is a good investment. They don't know why. They just heard about it on the news or somebody told them about it, and they don't really understand how the investment makes money. And so usually that investment is a fake asset. They come in many shapes or forms. Today, we see them as a 401ks, mutual funds, and a variety of investment vehicles that are nothing more than liabilities. They're made for the financial uneducated. Before a person kills their money in a liability, they should have a plan in place as to understand where that money is going and how is it going to be used to improve the total freedom or the cash flow that is coming into that person's life. Ultimately, passive income is what determines how wealthy we are and how much time we have without having to work ever to create money to pay for our living expenses and our lifestyle and all the expenses that we carry. How much time do we have? That's how wealthy we are. How much can we go without working? If it's 10 years, 20 years, depending on our lifestyle, and we have businesses that can produce 100 years of cash flow, then that's how wealthy we are. We're 100 years wealthy. So it's measuring time, wealth, not necessarily in just money. Because a lot of people have money, but they're not wealthy. They don't have freedom. So focus on acquiring the 3 E's every day of a master investor. Financial education is number one. Number two, financial experience. And number three, excess of cash flow. And invest with facts, not opinions. Master investors, wealthy partners also explain that the typical investor does not make a lot of money in the market. The average investor has a count your chickens before they hatch mentality. They call items that cost them money every month assets based on their opinions. They have liabilities, right? And they call them assets. And that's one of the main problems with the poor mindset and the people that operate on the left side of the cash flow circle, which are the employee and self-employed. They are, he or she calls an asset what really is a liability because the lack of understanding on how to read financial statements, how to speak the language of a business person, everything that we're learning inside of our community, they lack. The average investor does not have the knowledge that we have here at Master Investor. They can get it. Anyone can get the knowledge. It is a matter of a choice of what are we consuming, what are we reading, what are we spending time on building, what type of income. That's why rule number one in our community here, Master Investors, that we work to build passive income and multiply money through sound investing, because that's what a business owner and inside investor does every single day. The business owner number one's job is to raise capital, and the number one skill is to sell without selling using systems and smart marketing. And that's why we understand how to control systems, because the more we use systems, the wealthier we become. And it's control more important than ownership when it comes to building wealth. We want to focus on control because, as we say early on, we are going to be using debt. That means most of the time we won't own anything that we have, although we are creating passive income and we can own things, but if we can control it with debt, then it's even better, because it's not our money, it's OPM, it's other people's money, and it comes with a lot of benefits. We can minimize taxes and much more, as we're going to learn through today's talk and in every single content article that we have here at Master Investor. We shine the light on the benefits that investing for passive income has, instead of capital gains income and earn income, which earn income comes from a job and is taxed at the highest bracket, and it's impossible to become wealthy just with the earned income, although there are high paying employees and self-employed people that end up giving their money away to type A investors, and they end up becoming wealthy because they chose the right partners and they just love the profession. They could be a lawyer, a dentist, a doctor, somebody that they really love what they do, and they have a lot of customers and people that pay them a lot of money. Although they have to stay present to see their clients, they still can become wealthy. But it's just about 10% of the self-employed and employed people that can achieve that level of high pay employee. That's why it's nearly impossible to become wealthy unless you are the 10% of that field. In other words, if we're looking at an athlete, then the athlete should be paid at the 10%, with the 10% best players in the entire world of that profession, of that sport. If the person is not in that bracket, then that person is going to struggle financially if he or she doesn't invest, because he or she doesn't make enough money to beat inflation. And it's going to cost more money for the person that has a job to buy the same things that they bought years back, because inflation continues to rise due to the fact that today's economy works with printed money. It works with debt, as we learn here at Master Investor. That's why we appreciate debt. We welcome debt. We manage debt. We don't tell people be debt free. In fact, don't panic. If a person is in debt and all they have is bad debt, then the first step is to invest in financial education, implement the strategy of paying ourselves first, manage and control our cash flow, understand our financial statement, where we are financially today, and put a plan in action to create our first asset that will create passive income so that we can start paying the first small bad debt that we have, that we can take off our list if it's a necessity. If we can keep that debt there because we like to have that luxury, then maybe we build that asset just to pay for that debt, that bad debt, and we can keep that luxury item or whatever that is that we're paying every month that we want to have. And some liabilities can become our assets as well. It depends on how the cash flow is flowing. Remember, every liability that we have on our liabilities column is somebody else's asset in their assets column. It could be a company's asset in the asset column of that entity, or it could be a person. Usually, are companies, but we can turn those liabilities into our assets without affecting their financial statement, the entity's financial statement. Whoever's asset that is, it'll still show up as an asset on the assets column, even though we have it listed as an asset because we figure out how to turn it into an asset. It became an asset when it started putting money into our pocket and is making enough cash flow to pay for the debt service, the cost of that expense of that asset now. It used to be a liability. Some liabilities can be turned into an asset, and ultimately that's what we do. And we can get everything for free and create and recycle money over and over again, creating money from thin air that is tax-free We can even get into more debt because now we have excess of cash flow. And it's all about confidence because money is created with debt. Money is debt. Money is fiat money, paper money, fake money, an idea backed up by confidence. Today, money is a full currency. It stopped being real money back on August 15, 1971, when President Nixon separated the gold standard from the US dollar. From that point forward, money became monopoly money. It became what it is today, a currency. Just like crypto is just like the US dollar. They're both currencies. We can pay each other. The US Congress has accepted crypto as a currency, and we need to understand this because we can utilize crypto and the US dollar and debt, because today money is debt, to become wealthy. We operate with the new system, meaning that we do what the government does, which is utilize debt to operate and to minimize taxes and to move the economy forward. And when we do that, we become partners with the government. And we're going to learn that in just a few moments, more about why the government becomes our partner. Because we invest in sectors that they're interested for us to invest in, to improve the economy and the world overall. Master Investors Wealthy Partners also explains that the typical investor does not make a lot of money in the market because they lack financial education. They anticipate that the value of their house and stock holdings will increase in the future. They call items that cost them money every month assets based on their opinions. They buy, hold, and pray. That is a risky strategy. This causes them to lose control of their own finances. In our opinion here, Master Investor, that is extremely dangerous. Simply put, the average investor does not have the basics of money, business, and investing to create true wealth. Their language is not that one from a wealthy context. Make more money by working less. After that, there are people who work to earn a living. We offer this insight, the paradox of hard labor. Many people believe in hard work as the means of making money. The ability to construct and follow the cash flow triangle, as shown below on our screen, and invest with the tetrahedron diagram that we have on our article. We're going to see it in a minute. Then this approach will eventually lead to realization that the less effort we put in, the more tax-free positive cash flow we can make, and the more valuable our creation, business, or investments become. The most important words in business and investing are cash flow, and the second most important words are due diligence. They complement each other and protect the investor from bad investments. When we apply due diligence and we measure our return on investment with cash flow, meaning with facts, we invest with facts. Take a look at the cash flow triangle below and use the 8 integrities shown of a successful business. This way, we will ensure that we are controlling sound assets with our companies. As we can see, the cash flow triangle, we have the mission, team, leadership, cash flow, communications, systems, and legal, product. Some may need to retrain their minds and let go of all money habits after many years of training. It all becomes clear that investing in business are both a team sport. Our team matters. It makes all the difference in how successful we will be at building wealth. Our habit is to study the greats and become greater by applying the knowledge we gain into our lives. We have to learn to create, acquire, and combine systems that could function in our absence in order for us to create true wealth. we came to understand what meant by the less we work, the more money we will make after we constructed and marketed our first cash flow triangle. We refer to that line of thought as solving the cash flow triangle riddle. After all, a sound asset is a business or investment that is composed of a system of systems which is doing the selling and telling for us on autopilot. Because a business is created to solve a problem in the marketplace, and it does it without the need of us being present to make the sales, because it's using systems and a smart marketing. After that, we started mentioning the cash flow circle, right? And so we have now the cash flow circle on our screen, which shows the left side of the cash flow circle. We can see the employee and self-employed. They operate by trading time for money. They don't show up to work, they don't get paid. They work for active income, for ordinary income, or also known as earned income. Employee has a job, self-employed owns a job. World's population, 97%, is on the left side of the cash flow circle. World's wealth on the left side is 3%. On the right side, we can see the business owner owns and controls systems. Not work, we get paid. We can see the inside investor makes money work hard through sound investing. We focus on building passive income, make money through sound investing, right? And money and systems works for us. 3% of world's population is on the right side of the cash flow circle, and 97% of total wealth is controlled on the right side of the cash flow circle. The four categories of individuals in the cash flow circle each reflect the four distinct methods of earning a living. We have 1, employee; 2, self-employed; number 3, business owner; number 4, inside investor. The main difference between those in the employee and self-employed from the left side of the cash flow circle and those in the business owner and inside investor side, or the right side of the cash flow circle, is that those in the employee and self-employed side or left side of the cash flow circle frequently get overly involved and make the common mistake of prioritizing working in their business over working on their business. We must focus on working on our business and minding our business rather than working in our business like an employee. We delegate and use systems to ensure that the business can run on its own without us present. And it's important that we learn how to create wealth and how to create passive income while we're sleeping, because that is when we're going to learn how to use leverage, how to use systems even more, how to utilize marketing. We are always away, one sentence away, one system away, one new strategy away to become wealthier, because due to technology and artificial intelligence, we can put our product in front of the masses very quickly, within seconds, without exaggeration. We can literally be selling our products online very fast, faster than ever before we have seen in history. Therefore, let's take advantage of all the tools in artificial intelligence, because as an inside investor, it's our duty to capitalize on all new opportunities as we're growing our bottom line. Master investors' culture is that the key to financial success is laziness. What we mean by this is that we have to use our minds to become wealthy more than focusing on physical work. In other words, the more hands-on we are, the less money we can make. Financially successful individuals do not roll up their sleeves in labor. Instead, we come up with creative solutions to accomplish more with less legally. and we give our teams the tools they need to succeed on our company's behalf. Don't be the average investor. It is critical to know how we generate money and whether it is truly making us wealthy in order to succeed. For us here at Master Investor, for instance, we are a type C investor in mutual funds because we don't use mutual funds because those are fake assets. We consult with tax and wealth strategists, stockbrokers, bankers, and real estate brokers as a type B investor looking for expert advice on our financial issues. These experts give a ton of knowledge that the average person doesn't have the time to learn on their own, but only when we locate the good and qualified ones. Not all professionals are cater for the wealthy context. Additionally, our partners and members here, our master investor is a type A investor who earns a sizable income by resolving issues that others are unable or unwilling to address. In areas where we may lack expertise, we could potentially hand over tasks and delegate to other reliable type A investors who have knowledge on that field. Like I mentioned earlier, we are going to combine forces with type A investors, with like minded investors who are in the business of investing and producing positive cash flow through investing. And we're going to ensure that we're building real partnerships that are win win partnerships from the beginning, partnerships that are producing passive income for all parties involved. We need to ensure that we build the right investment strategy for every single dollar that we have access to. It's all about having a plan because investing is having a plan. And we need to ensure that we have a winning plan with a lucrative exit strategy. As an inside investor, we know everything about the investment, and because we are creating the investment, we're putting the deal together. We have control over the assets and liabilities, and we have a voice, and we are actively involved in building the investment. And that's why we have that control. We want to have control. Control is more important than ownership. However, we're going to be creating win-win partnerships all across the board. The average investor, or the average is for the average investor. This is why we don't have to be ordinary or average. We must strive for extraordinary results. Many investors have been investing for less than 20 years. The majority have either never experienced a market collapse or held real estate that was worth considerably less than what they paid for it. These fresh investors approach us and begin reciting industry averages. Averages are for average investors. An inside investor wants control over our investments. We value more control than ownership as an inside investor. We want to control the asset and its cash flow more than owning it, as we will be using good debt as much as possible to invest in assets that we control for passive income. And if we're using debt, that means that somebody owns that money or that debt, and all we're doing is controlling it for them in such asset that they're also were interested, and that's why they were able to provide us the loan, because they knew that that asset was a sound asset that is producing passive income enough to create a return for them and a return for us. And that return is passive income that is tax-free legally, is money from thin air. It's money for nothing. Is the holy grail of investing. Averages are for average investors. An inside investor, we want control. And that control starts with ourselves, our financial literacy, our information sources, and our own cash flow. Yes, sometimes we will control assets that will pay us a capital gains income rather than passive income. Here at Master Investor, we will focus on investing for real assets that produce passive income, or also known as positive cash flow, in all the asset classes that exist. However, in certain occasions, we will have assets that will create capital gains income. And when we do profit on those assets, we will attempt every single legal strategy to defer taxes on those capital gains income by investing and rolling those profits into a new cash flow and asset. For this reason, don't be average. It is what we tell to the typical investor. Here at Master Investor, consider being an average investor to be a risky investor without financial education and a lack of mentors. We must strive to be an extraordinary investor that operates on the right side of the cash flow circle, someone who is an inside investor and a business owner that understands how to raise capital and how to multiply money through sound investing. Furthermore, if you want to be the sort of person who makes assets that purchase other assets, we must discover ways to do less in order to produce more and construct more. As we can see, we have arrived to the cash flow tetrahedron. We have our businesses providing us positive cash flow, and that income is being used to pay our expenses, our living expenses, and business expenses as well. And also, the business income is being used to invest in other asset classes, such as real estate. And that real estate is producing passive income as well. And that income is being used to pay for more expenses of ours in other assets, in different asset classes. And the expenses become also part of our investment strategy, meaning that we use and turn expenses into assets because we are putting investing as number one expense on our expenses column, and we are turning liabilities into assets as much and legally possible from our financial statement. We need to look our financial statement daily, in every business has a financial statement. So we look at our personal financial statement. If we have a new business, we have to have a financial statement for that business. That business has a financial statement. Every investment or business, just like every person, has a financial statement. And our goal is to build the assets column of that business or entity so that we can increase the passive income or bottom line of that business. So that is our goal, is to build businesses that eventually build enough passive income that we pay for our living expenses. We don't have to pay or work for earned income to pay for our bills. We're using businesses to pay for our bills, and we're using those businesses as leverage to buy other investments. Now we're creating everything for free because we're using our business income to pay for our expenses. We are using that income to also buy other investments that are producing more passive income, more into our bottom line, and is giving us more total freedom. So the strategy is to focus on building businesses that cash flow so that we can utilize that as leverage to buy us other investments. And that's the holy grail, because there is where we're going to reach infinite return investment. That's when we have zero of our own capital invested into a deal. However, we still control the deal and collect passive income without having any of our capital invested into the deal. And that is key when we become successful investing, we want to achieve that level of return on investment, which is infinite return on investment, or also known as IROI. Take charge. To become wealthy, we must manage our personal cash flow as well as our financial education. As long as we maintain control over our finances now, there's nothing wrong with expecting that anything will increase in price in the future. The inside investor understands that having a good financial education gives us more control over our finances now. And if we continue our studies on financial education, then even more control in the future. Stop being an average investor. Stop being an average investor right now. Get involved with the proper mentors. Begin creating a future where we have control over our money and our investments by making an investment in our financial education right now. Put a business plan together to invest for passive income with a lucrative exit strategy. Take massive action with a winning plan, because the life that we desire is literally a decision away and a sound plan to get there. Investing is having a lucrative plan in place. Everything is calculated and secure by facts. Bonus question: what are the pros and cons of real estate investing? Real estate investing has many benefits and very few drawbacks. We must be aware of what they are and the actions we must take to begin. Knowing the pros and cons of real estate investing are essential to our investment future. Successful real estate investors always start small, although it takes the same energy to do a big deal than is to do a small deal. As we learn, we're going to understand this, that is literally the same steps. So don't be afraid to go big, even on our first deal. If you can handle it, then go ahead, because the bottom line or the return on investment should be higher when we go into a bigger deal. And we also have better support from our investors and our partners, because the bigger the deal is, then they stop looking at us and instead they pay attention more to the deal because it's a bigger deal. That means that we have more paperwork, more cash flow, and more room to bring other investors and other ways to raise capital to finance the deal. So we're putting the deal together. And when we have a good deal, money finds us. We attract money, or we find the money. Remember, success is something that we attract by the people that we are becoming, by the type of investor that we are today. And we have to act like the type of investor that we want to become, even before we have all the things that we want to have. So it starts with the mindset. It's all about thinking and growing wealthy. There are several ways to earn income from real estate investing, but positive cash flow or passive income and capital gains income appreciation are the way. So we have passive income and capital gains income. The person that flips a house is investing for capital gains income, and capital gains income comes in one time. Usually when we purchase something at a certain price and then we sell it at a higher price, those gains are called capital gains income, and they are taxed at a certain bracket higher than passive income. Now, if we turn that house into a rental and now we're receiving passive income every month from the renters, we're using that income to pay for the debt service, the mortgage, all the expenses of the house, the cleaning, etc., the taxes of the house, and we still have positive cash flow left. That's our bottom line. Then that is passive income. And now the house is controlled for passive income instead of capital gains income. Different approach and different strategies. And when we do for capital gains income, then we need to master how to defer those taxes by utilizing something that is called the 1031 exchange in real estate. And that's when we roll the gains into a bigger real estate property or investment, and we can defer those taxes indefinitely as long as we continue to follow the law and do what the government wants us to do, which is to invest in different sectors, one of them being real estate. And real estate is one of the asset classes that exists today. Using real estate to build our wealth is a smart step. to take, as it is an asset class that allows us the use of debt to invest in different assets. Getting wealthy is all about mastering how to manage debt as much as possible. Debt generally is tax free. When we use it to build our wealth, such debt is tax free. The holy grail of investing is to reach IROI, infinite return on investment, and be tax free wealth entity legally, because we are using the tax code and corporate laws to our advantage, as they were created by the wealthy to make the wealthy context wealthier. Anyone can learn the new rules of money and use the laws to create true wealth. Today, money is created with debt, and that is why the USA is $33 trillion in national debt. Due to this fact, inflation will continue to rise. Today's currency, the US dollar, will continue to lose value all the way to its intrinsic value, which is zero. And new currencies will emerge like crypto. We must actively adapt and invest to beat inflation in bad economies. So, the way we protect and hedge for inflation in any type of economy is by actively investing in different asset classes, not by simply putting our eggs in one basket or one asset class and have only stocks. That is not the way to protect or successfully invest. We need to focus on building businesses that create passive income and controlling assets and investments that are paying us passive income, and we're using that passive income and we're using debt, other people's money, through a credit card, loans, whichever other way we can get capital legally to invest, then we're using that to invest in different assets, in different asset classes, not just in one asset class, because when one asset class is not doing well, we have investments that are doing very well in different asset classes. So we continue to live a life of freedom. We don't have to worry about running out of funds because we have control over assets that our companies control 100% for passive income. And sometimes we'll have capital gains income. However, passive income is what gives us total freedom and true wealth, because true wealth is measured in time, not necessarily in just money, as we mentioned earlier on. Due to technology and artificial intelligence, everything is changing so fast that we have to also be fast. And we need to put systems in place so that we can sell worldwide at the speed of light, because we can. Do we have any doubts about whether an investment career in real estate is the best option for us? Real estate investing is something that we are familiar with and fond of. Everyone in real estate who has success started small and continue to build. However, keep in mind that the same energy, procedure, and effort goes into a bigger deal. So let's get comfortable by thinking and aiming big. We acquired a 6-unit apartment complex after we were ready to move up to bigger deals. Currently, we control many residential units for passive income, utilizing good debt to leverage our tax-free positive cash flow. We gain little and gradually expand it. As we can see, almost all prosperous real estate investors begin modestly as well. The cost will be clear to us soon. The highest expense the average human has in their lifetime is taxes. The reason being is because the average investor does not know how to minimize taxes legally, because he or she is only working for earned income, which is taxed at the highest bracket automatically. They have no room to minimize taxes. Even before they touch their paycheck, their taxes have already been deducted from their paycheck. And so it leaves them no room to really minimize taxes, because the rules and laws were not created for the employee and self-employed in the capitalist system, which means that no paying taxes is actually patriotic in the capitalist system. A lot of people think that paying taxes is being patriotic, and it's not. The capitalist system And a capitalist understands the power of not paying taxes legally because we are providing things for the economy already. We are creating jobs and we are investing in sectors that the government wants us to invest in to grow the economy and also protect human lives and encourage the growth as a world. And when we do something that is that great and we're solving problems in the world because we are looking out and we're seeing problems and we're addressing them with product based businesses that are successfully selling a product to solve that problem for the customer, then we are doing something that is worth wow, not for us, but for the world. And when we do that, we are aiming to having and controlling real brands. And that's the key of having a legacy and having total freedom and really reaching the lifestyle that we all desire. We all have different wants and needs, and it's all about how are we going to achieve it. Are we going to do it the wealthy way, which is to think and grow wealthy? Doesn't say to work hard and grow wealth. It says to think and actually be lazy physically and think and be actively investing. Spend time at building passive income rather than earn income. The poor context believes that paying taxes is patriotic. The capitalism system is created to pay zero in taxes legally. Therefore, it's patriotic to find legal ways to minimize taxes. And as a business owner and inside investor, that's our duty. To be clear, we are concentrating on rental real estate that generates a positive cash flow, such as single family houses, duplexes, triplexes, apartment buildings, motels, office buildings, hotels, retail stores, shopping centers, storage facilities, warehouses, mobile homes. More on that in a minute, etc. When discussing real estate, it is crucial to understand that there are several investment possibilities outside of a typical home. Advantages of investing in real estate. Let's explore the numerous justifications for making an investment in real estate. Number one, use of OPM, or also known as other people's money. Do we believe that we need to take money from our own savings or launch a GoFundMe campaign in order to buy a home? Think again. In a nutshell, the idea behind OPM is that a bank, lending business, or private individual will finance the balance of our funding if we make a down payment of a 10% to 30%. This implies that for only $10,000 to $30,000, we may purchase a property worth $100,000. Where else in life might we find a bargain like that? Understanding OPN may be one indicator of the financial literacy we have gained from Master Investors material. We must become creative when building wealth using our minds to raise capital from thin air by mastering the ability to put extraordinary deals together that attracts money. And the down payment of such real estate, whether it's 10,000, 15,000, 30,000, or whatever the down payment may be, can also be financed through debt. If we have a credit card that holds 30,000, then we would use that credit card as long as the numbers work. We have to crunch the numbers. We have to now add the 30,000 expense into the expenses column of that asset, of that business, whatever we're going to acquire. And we need to crunch the numbers. Now we need to deduct whatever we're going to be paying back, the minimum back to that credit card every single month, because we have to make positive cash flow every single month. So we have to make sure that all the expenses are covered. In addition, we need to have our part. Otherwise, it wouldn't make sense. However, we can see that we can use 100% finance to fund our deals when we use our creativity. So we need to follow the think and grow wealthy mentality. Number two, cash flow. A property may provide fantastic prospects for monthly income if it is acquired and managed well. Master Investors community adores real estate because of this continuous stream of income from investments, positive cash flow, or passive income, which is known as cash flow, in addition to allowing the ability to increase cash flow through phantom cash flow, depreciation, appreciation, taxes, and other incentives. That's what phantom cash flow is the type of income that shows up somewhere else through those different strategies that we can apply when controlling real estate, and we can use to maximize our infinite return on investment when investing in the real estate asset class. When we acquire and lease out real estate, we will get the rent every month and then use it to cover costs like the mortgage and any necessary repairs. That positive cash flow is our profit. If we buy it at a decent price and we can use 100% debt, that's even greater. Keep a tenant and earn more money than we spend every month. Isn't it gorgeous? Number three, appreciation. We may make income from rental properties in two different ways. The second is appreciation, and we have previously covered cash flow. Appreciation is the term for the gain, or also known as capital gains income, we can make if we choose to sell after our home's value has increased. Keep in mind that we should always have an exit plan in place, even if we are not purchasing with the intention of reselling it to make a quick profit, like the flippers on television programs who renovate a house and then list it for sale right away in the hopes of a huge payout. 4. Fewer highs and lows. Do we not like the anxiety of seeing a stock market ticker go by every time? Because it is often a long-term investment, a cash flowing property is not susceptible to the everyday fluctuations of the markets. And as we may be aware, a decline in real estate market may be the ideal opportunity to acquire. Loans are cheaper in a down market, giving us more room to realize a hefty passive income from thin air using good debt. Thus, we may be in the unusual situation of feeling thrill while everyone around us is inches and losing money, because we are applying the new rules of money. We are investing with the wealthy context. We have adopted the new rules of money. Trust us, it is a great place to be. 5. Tax benefits. Tax credits are offered for select real estate investments as well as for low-income housing and the restoration of historic structures. A tax credit lowers the amount of taxes due by reducing it directly. We also get a yearly depreciation deduction, which is often a percentage of the value of the property that may be deducted as an expense against sales. Lastly, in certain nations, the revenues from the sale of real estate may be put off forever, provided that the proceeds are reinvested in other real estate. Here in USA, we use something in the law that is called 1031 exchange, as I mentioned earlier, which allows us to roll the gains over into a bigger asset. As a reward, we get to defer taxes on the capital gains income, and yeah, we control a more valuable asset that produces even bigger returns on investment. Wow, what a plus. Number 6, less stressful. When it comes to investing in real estate, there's not need to make a quick choice. Generally speaking, we have time to conduct due diligence, crunch data, compare opinions, facts, and then choose the best investment choice. Therefore, we must get active and execute our plan at the right time. The drawbacks of investing in real estate. When it comes to real estate investment, it would be incorrect to ignore the little drawbacks. It is crucial to have a full picture before jumping in After all, number one, time lag. Time is required for appraisals, inspections, finance, offers, encounters. Patience is a virtue for this reason. We will know what to expect in future situations after experience it once. Just concentrate on each stage separately during our first time out and utilize the lag time to conduct additional study to make sure we haven't missed anything crucial. Number two, not in liquid form. It is tough to swiftly convert real estate into cash since we can easily jump in and out of it unless we have a buyer ready and in position to acquire what we have. Remember, number six, where I said that time is on our side. If we need to sell fast, though, that is not the case because we're investing for passive income. Number three, challenging or time consuming. After business, real estate is the second most challenging of the five asset classes. The management of properties, including empty units and problematic tenants, must be done on a daily basis. For this reason, we advise beginning little since it will occupy less of our time and we will also make far fewer errors on a smaller scale. What then, now that we are aware of the advantages and disadvantages, starting out and taking the first small steps, which of this appeals to us? Three popular methods for beginning real estate investing. Number one, rental real estate for residential use. After purchasing a house, we become the landlord of our future tenants and are liable for the mortgage, taxes, and upkeep expenses, and maybe a property manager if we don't want calls about broken appliances at midnight. Ideally, we would like to be able to bill more than our monthly expenses in order to generate a positive cash flow. This is our income stream, which is our compensation for renting the property to a high quality tenant. And our real estate is as good as our tenants are. So we need to choose our tenants wisely. And usually, when we use platforms such as Airbnb, if we're starting out with houses, residential houses, and turning them into short rentals for tourists at the right locations, remember, location, 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 and attracting the right tenants, making sure that they're all are vetted out through the platforms that we're using so that we cover our liability on our end. It's all about covering our behind in business. It's about putting the legalities in order and shifting liability successfully and legally through the knowledge that we're gaining by investing in financial education like we're doing right now, which is unusual for the masses. And that's why they end up working for money for the rest of their lives because they haven't figured out and they haven't put up the time that requires a person to transform the life internally when it comes to shifting from the poor context to the wealthy context. At the end, there are two types of mindset, the poor and the wealthy when it comes to money. Whether the person has a lot of money or make a lot of money at their job does not make them wealthy. What makes us wealthy is how much time can we go right now without working and we can still thrive, pay our bills without having to worry about running out of money and still be able to live above our means and grow and expand, not shrink. A lot of people retire and they end up shrinking because they don't have enough income to support their lifestyle that they used to have when they were younger and they were working full-time jobs. We don't want to be on that scene later on. We want to ensure that we have in our controlling assets that are producing passive income in all types of economies. When the economy goes up, when the economy goes sideways, or when the economy goes downwards. We understand the economy goes up and down. So we invest with a plan. We don't give our money away to anybody to invest it for us. We understand there are five different asset classes that exist to invest. We have business, Number one. Number two, real estate. Number three, crypto. Crypto is the newest asset class and it's also a currency. And number four, we have paper assets. Number five, commodities. And they all require financial education. Here at Master Investor, we have financial education for each asset class. Go to our website, get our digital courses. We have three. We have the 10-year rules of money, how to build cash flow with the internet, turn passive income on, and how to invest in crypto to build wealth. We're working on releasing our fourth and fifth ebook and digital course very soon. Stay tuned. Turn on the notifications. If you have a question, drop it in the comment sections. Let us know your thoughts on today's talk, and we're going to come back and answer any questions as we get them, and invest in our mentors. Make sure that we are constantly finding out the right sources we're seeking, because when we're connecting with the right group of people and we connect with one person that is the right person, now we're connected with the entire network of that person. So our net worth grows literally by the level of connections that we're building. And we need to get those emails and those names, and we need to understand how to have systems in place. So we have 5 different asset classes that we can focus on investing. Is our choice which one are we going to start with. We recommend people to start building a business that produces passive income to cover for the living expenses so that they can reach financial freedom, and then continue to build on the assets column in different asset classes, using that passive income from the businesses to invest in real estate and the other asset classes, and eventually turning liabilities into assets by applying the strategies that we're talking about and covering here on our community at Master Investor. To illustrate, we begin with no money, no cash flow, and a few rental units. Now we control many across key locations where the demand is high. When it comes to real estate, we must focus on location and numbers. We really begin with one investment home using 100% good debt, which didn't require any money of our own. The down payment was put into a credit card, and then we used the cash flow to pay all the expenses, including the credit card cost we use for the down payment. Debt is money and money is debt in today's economy. 2 types of debt. We have good debt and we have bad debt. Nothing wrong with controlling bad debt as long as we have good debt. In fact, majority of people only control bad debt, but that's the problem. They only have bad debt. They don't have good debt. The key is to have good debt, and hopefully we begin to acquire good debt before we acquire bad debt. And that's how we stay ahead of running out of money and being able to expand and continue to live above our means. When we build wealth, we want to expand. We want to live above our means, not below our means, because when we live above our means, we're now using our creativity to do less and make more. And we understand the power of leverage. So we want to focus on the assets column and invest for passive income, which requires a higher level of financial education. And that is perfectly fine because we are okay in investing in our context, because it's more important than the content. So our mindset, the wealthy context that we operate with, is critical. It's more important than the content that we consume. As we have good debt invested in sound assets, that their cash flow is how we pay for the bad debt we control in our lives. So we use the cash flow of our assets that is coming from the good debt that we use to pay for the bad debt. So everything is free at the end of the day legally. We position ourselves to obtain everything for free. We must live above our means and expand to build wealth. Do not shrink and live below your means like majority people preach out there, as it is the result of that person who operates with the poor context. Number 2, trust for investing in real estate. When a firm or trust utilizes investors' funds to buy and manage income properties, residential and commercial. A real estate investment trust, or known as REIT, is formed. Similar to any other stock, REITs are traded on the major exchanges. According to Investorpedia, a company must distribute 90% of its taxable income as dividends in order to maintain its REIT status. As a result, the REITs are not subject to corporation income tax, unlike a typical firm that will be taxed on its earnings and then have to choose whether or not to pay out its after tax earnings as dividends. Because of their consistent payouts and enormous potential for capital appreciation, REITs have been a favorite option for investors ever since the 1960s. We encourage those in our community here at Master Investors to master how to actively invest and manage debt instead of giving the money away to somebody to invest it for us, as it takes control away from us and ultimately reduces our return on investment. Hand the money to someone to invest it can increase risk if the person or entity lacks financial education. However, there are type A investors that are great at doing what we do, invest and multiply money. So lucky to those people that get to find those partners that can invest money successfully. Number three, investment companies for real estate. This option might be the best choice for us if we want to control a rental property but don't want the hassle of being a landlord. Similar to small mutual funds for rental homes, a corporation will acquire or construct a collection of apartment complexes or condominiums and then give investors the opportunity to purchase them via the company, thereby joining the group. The firm that runs the investment group is in charge of managing all the units, handling maintenance, marketing vacancies, and interviewing potential renters in return for a cut of the monthly rent. When we invest in real estate, we automatically tap into incentives that are legally provided to us by the movement, because we are doing what the government wants us to do to move forward the economy. And these incentives are legally provided by the government. When we invest in certain sectors, such as in real estate, then the government becomes our business partner, as well as the banks become our business partner. They are interested in putting capital to work in sound assets. Real estate is an asset class that banks, private investors, and governments are interested in investing in, with an inside investor controlling the deals. Our financial statements are report cards in the world of investing. Here below is a diagram of what the government expects us to do. Government wants to create more jobs, provide affordable housing. Who creates more jobs and provides affordable housing? Business owner and inside investor. Business owner receives tax breaks to encourage job creation. Inside investor receives tax breaks to encourage housing. For real estate investing, success begin small when necessary. Now that we are familiar with the advantages and disadvantages of investing in real estate, as well as some strategies for getting started, let's discuss why every successful real estate investor began with a very modest investment. It is probable that we also begin small if we control or are invested in real estate. Mistakes are unavoidable given how much there is to learn. It is all part of the procedure. It is far easier to make mistakes on smaller properties with less capital when we are just starting out. Let's use an example, Maria, as a close example, to show how little we may begin and turn a profit. She was a Buddhist monk, and His Holiness the Dalai Lama's company. She did live a very frugal life, thought she never made a vow of poverty, which is not necessary. After a costly medical scare, she understood the importance of money in her life and began learning about finance and investment. Her quest led her to mobile houses, a low cost and comparatively simple way to enter the real estate market. In many cities around the world, mobile homes are not a common sight. They are houses that are built or prefabricated and are theoretically capable of being moved. Maria discovered that she could purchase a used mobile home for roughly $3,000 and earn a monthly profit of about $300. Her investment has yielded a really good return for her. Additionally, Maria learned that California, where she resides, classifies a mobile home as a motor vehicle. This house does not require her to go through the complete real estate process of acquiring a title. She just walks to the Department of Motor Vehicles and picks up the title. This is a practical option for her since she started increasing her assets column while also having several duties that do not bring in any income, as such her job as a monk. And the focus is investing for passive income on the assets column. That's the difference, not for capital gains income, but for passive income, or also known as positive cash flow. And with that, the advantages and disadvantages of investing in real estate are crystal clear. Creating true wealth in real estate makes us financially free when we can overcome the few drawbacks stated above, which are by no means insurmountable. They just require expertise and ongoing financial education. It's not that the kind of the legacy we will want to leave behind, and a life of not worrying about running out of money on our retirement, and instead have a lifestyle of total freedom because we have positive cash flow, or also known as passive income, from our assets and all the asset classes of today. Finally, many of our deepest seated fears are based on unrealistic expectations in all habits. By thinking about them rationally, we can identify what is real and what is just arising from an ongoing script in our head. The fear of risk, fear of failure, and fear of being perfect. At some point, we simply must overcome our three main fears: potential humiliation, and declare, I overcome my fears by taking massive action, and I am doing this. Start taking actionable steps. Invest in our digital courses and ebooks. We have the 10 new rules of money, how to build cash flow with the internet, turn passive income on, how to invest in crypto, find more content on our social media platforms. Instagram, we have a podcast, newsletter, YouTube channel, TikTok. We have our digital courses, Facebook page, Discord. Join our inner circle. Today we cover what type of investors are we. Master Investor's mission is to be the global authentic brand of money, business, and investing that elevates the financial well-being of humanity through high-quality financial education made simple with lucrative opportunities to build passive income, win-win partnerships, and true wealth. As we know, we have three types of investors. We have type C investor, type B, and type A investor. We want to strive, of course, to be type A investor because that is an extraordinary investor. That is an inside investor who knows how to raise capital, how to multiply money in sound investing, how to use debt. We understand what is wealth. We also grasp very well that we can minimize taxes legally, because being a capitalist is understanding how to utilize the tax code to our advantage in the corporate law to gain control over our finances now and for our future. Make sure to visit our website, subscribe to our newsletter so that you can get access to all of our articles that we're publishing every week, and we can create more wealth by implementing what we're learning inside of our community here at Master Investor. bring you the good and bad news of money, the business principles that work in all economies. Stay extraordinary and wealthy. Thank you for spending time, and thank you for your business here at Master Investor. Talk, talk to you next time. Bye for now.